news. And I think one of the important discussions that we should be talking about is China. China is on shaky grounds at the moment. Okay. Now, China has been trying all means to ease investor concerns about its economy, and we have seen the government itself trying to placate, these investors and telling them everything is fine, and then they don't worry, we will come in, we will do things. But and with those kind of announcements, right, the Chinese market rebounded after getting the initial announcements, but this bullish momentum eventually fizzled, right? So, and one of the main reasons why is that China is actually facing deflation, and this is the total opposite uh, of the rest of the leading economies. Everybody is facing inflation, but China is looking at deflation. And the key reason behind this deflationary issues in China is the slowing down in domestic spending. Now, if you look at the important inflation data, which is the CPI data, the year-on-year CPI fell 0.3 in July after recording 0 in June. So this is a first negative inflation since early 2021. So it's not a good thing because expectations were really, really high for Chinese goods. The demand for Chinese goods would ramp up after the pandemic restrictions were lifted. And do remember, China had one of the strictest COVID policies, which is the zero COVID policies, and that really, really hurt China big time. Now, the expectations were the moment you release it, everybody would just come in and pump up the economy. But currently, it is the other way, because signs are now showing demand is on the wane with a slowdown in exports and imports as well, right? And not only that, because the local retailers are under pressure too. Overstocking is the main culprit and now under pressure to cut prices, contributing to this deflation. So they also thought, when they opened the retailers, the small retailers and the meat retailers or whatever, they also thought the same thing. We are going to buy more because, people have been deprived of this thing. So the moment open, the floodgates of orders will come in. That did not happen. Okay. And it has come to the point where the Financial Times reported that Chinese authorities have put pressure on high-profile local economies to avoid discussing negative trends in the economy, including deflation. Now, that is not a good sign. If the Chinese authorities are actually stamping this, that means it may be worse than what we expect, right? So now, slower than expected pace is seen in retail sales, industry outputs, and investments. If its biggest developer, so check out this news, if the biggest developer, Country Garden's financial trouble worsens, it will weigh on the housing market in the near term and risk the Chinese economy slipping into a recession. This is the part where we need to look. The moment they announce this thing, then it's really going to be bad. Okay, so at the end of the day, this thing here is that what is really happening, with all these things happening over here, that explains the reason why, because that's with the possible Chinese recession, we actually saw the investors flock to US dollar safe haven currency of late. And that's one of the reasons why we keep on seeing that the US dollar keep on going higher and higher and higher until now. Okay, so at the end of the day, I think the question is this: will the Chinese deflation help the US inflation? Okay, now while it's true that US consumers will be paying less for Chinese goods, personally, I see the effects as minimal. Why do I say that? Now, if you look at the US consumers price index, right, it's heavily weighted towards housing, food, energy, healthcare prices, and these are generally heavy reliant on Chinese imports. Okay. And if you were to look at the overall situation in the US, right? After the July rate pause, here the FOMC meeting minutes reveal only two policymakers prefer to hold rates in July, and the rest prefer to continue battle against the sticky inflation by raising interest rates by another 25 basis points. So this inflation thing, although it's slowly coming down, we do see that but whatever is happening in China, you know, it can't help that much. It's seen as minimal. And the FOMC, committee understands that, they see that, and that's one of the reasons why they are continuing to battle this inflation by hiking its rate by another 25 basis points. Now, if you look at the overall situation, it's not that, it's like we are on the fence right now, and to the point where that's a possible tip towards the economy actually getting bad from here. Like I've already said again and again, if they continue increasing interest rates, the Fed is always slow in increasing its rates, and they're always slow in decreasing its rates, in cutting rates itself. And with a high interest rates environments, things are bound to crack. And we have seen this S&P, the NASDAQ, all slowly coming down. So recently, we had Dr. Michael Burry from The Big Short. If you have seen this movie, you know who Dr. Michael Burry is. If you're not, he is the guy who, one of those few who actually saw the subprime issue in the US and basically shorted 2 years in advance all this, the housing market, and made a billion out of it. Okay, he made a huge bearish bet and made a billion out of it. So if not, I would recommend you go and watch The Big Short. Okay, it's an entertaining movie, and it's not that really difficult to understand. So I really recommend you all to have a look at it. Okay, so now, what Dr. Michael Burry did this time here, instead of betting against the housing market, he's betting against the S&P 500 as well as the NASDAQ. Now, if you think that you're going to panic right now because I'm talking about this, and you're going to start selling the S&P right now, start selling the hold your horses, because critics of Dr. Burry here called him out, stating his trade calls on X, the platform formerly known as Twitter. After the subprime crisis, he made a huge profit, but results were not expectations for those who followed him right after, right? But the size of his bet, however, cannot be ignored. The combined notional value of the two positions was a hefty $1.6 billion on June 30th, right? And those who are familiar with options, Dr. Burry's option would have cost him a fraction of that amount, depending on the expiry date of these options. And looking at it, I think it could cost in the region of $50 million. His bet. This is the size of his bet. So at writing, probabilities are showing that the Fed would not hike its rate, but if they do, or something cracks in the market, it will be a windfall for Dr. Burry once again. Okay, so that's cool, right? Now, the S&P 500 and NASDAQ has started its descent. It's coming down, but prices are still above the June levels. That's why he's losing money. But, there is potential. Later, when it comes to charts, I'll show you. But at the end of the day, I personally do not see this as a market crash, but more of a correction instead. Because if you want to talk about the crash, it has already crashed, and then usually the cycle is like at least 4 years, 5 years. So we just had one crash in 2020. So if you want to have a next crash again, I think it won't happen that fast, right? So that's why I think it's more of a correction instead. But if it were to categorize as a crash, the S&P would need to drop to 3685 and the Nasdaq 12616 minimum. Okay. So later on, when it comes to the charts, we will see. Okay. And finally, I want to address what the other thing that the other big issue that actually came up